these rules may feel constricting, but that's really the point for stage 1 and stage 2 traders who are experiencing a negative equity curve, not a lot of confidence, not a lot of success. The first sell rule for these folks is to sell at 5% profit, sell half of your position, and move your stop up to break even. So that's very simple, very easy to do. And that's a lot about this. The rules we're trying to bring here is keep it simple, because keep it simple means that it's going to be a robust system. And this is the first variation where instead of selling 50%, you're selling a third at 5%, a third at your average gain, and a third at 2 closes below the MA. So here is your initial sell of 5%. You've got remaining 66% instead of 50%. Your sell 2 is at your average gain, which we used in this case, an average of 10% gain. You sell 33% and you've got remaining 33%. Then the stock trends and you've got your normal sell rules below the moving averages for swing traders down here and position traders up here. And the goal for stage 1 and 2 is all about building consistency, establishing an initial system to actually test out who you are as a trader. Stage 3 and stage 4 is more about performance and actually performing really, really well. And sell rules will adapt to the character of the stock and the actual market environment. Maybe the market environment is rewarding strong trending markets, holding onto positions longer. You adapt a little bit more and lean more into selling into weakness versus selling into strength. And sell rules are tailored to the trader's biases, selling into strength or weakness, again, based on their personal way of interpreting the markets. And instead of rule 1, which is sell at 5%, you can sell at extensions as your first sell instead of fixed levels. So you get a little bit more variability in your sells, but it might lead to increased performance over time. You want to avoid overfitting and think about a rule set that is robust, that will adapt to different market environments, both really great trending ones as well as choppier ones, and protect you in those situations. Be aware that a rule set that worked really well in a strong trending market environment may perform horribly in a very choppy, up and down volatile market. So sell rules for stage 1, 2, focusing in on that subset. So this is you, really pay attention here. Again, at this point, you're just starting out in your trading journey. You're trying to establish a system for the very first time. And your goal is not to perform. It's not to go out and make triple digits like US investing champions that have been trading for 7, 10, 20, 30 years. Your goal is to actually build a system that protects you and allows you to build techniques that will help you in your future stage 3 and stage 4 periods later down the road. So again, the major goal is consistency and building sound habits, building technique that will help you later on in your career. So for these traders, and these rules may feel constricting, but that's really the point for stage 1 and stage 2 traders who are experiencing a negative equity curve, not a lot of confidence, not a lot of success. That's the reason why these are so strict, is because we're trying to help these stage 1 traders stop the losses and allow them to participate in the winners. So the first sell rule for these folks is to sell at 5% profit, sell half of your position, and move your stop up to break even. So that's very simple, very easy to do. And that's a lot about this. The rules we're trying to bring here is keep it simple, because keep it simple means that it's going to be a robust system and not be overfitted to one period where everything's working really well, trending well, while another period where it's a pop and chop type market where nothing's working. So we want to build a robust set of rules that helps us survive all those trading environments. So again, the first sell rule for these folks in stage 1 really, and then also stage 2, is at 5% profit, sell half and move up your stop to break even. Sell rule tool is kind of divided in two based on whether you want to be a swing trader or a position trader. And for swing traders, sell the last half on 2 closes below the 21 EMA. For position traders, it's basically the same exact thing, except instead of the 21 EMA, you're looking to sell on 2 closes below the 50 SMA. So again, if you want to be a swing trader, use this one. If you want to be a position trader, use this one. And these are guidelines. And of course, you want to adapt it to your own personal situation. And it doesn't really matter if you use the 21 EMA versus the 21 SMA versus the 20 SMA. Pick what you find helpful to you and, adapt these rules to what you find to be very, very helpful. All right. Let's see. So here's an example of an application of this rule set for VST. You bought through the consolidation pivot here. You manage risk at the low of the day here as it reconfirmed through the prior day high, as well as this key level. And your first sell is very simple. Up 5%, you sell 50% of your position. So remaining, you have 50% to ride that prior trend. The 21 EMA, which is this line right here, has moved up through your costs, so you're doing well, and the stock really shoots up, trends beautifully, and you ended up selling with 2 closes below the 21 EMA for a swing trader. You sell the last bit of your position, sell 50%, remaining you have 0%, and the result is a really nice gain of just under 20%. If you were a position trader instead, again, you would have sold your first sell right here of 5%, but you would have gotten a little bit more of a profit and end up being a net result of up 31%. I think this was up about 50, a little bit 50% here. You've got around 83 all the way up to 135 or so. So really nice solid gain, and you get a net result of 31.5%. And I want to pause here and talk a little bit about, just for a moment, about the pros and cons of swing trading and position trading, because really they can be both extremely successful. You see US investing champions with both styles. However, swing traders are going to be dealing more in the momentum moves, and there's a little bit more potential because once a momentum move ends, they can move on to the next one. While position traders, there is maybe the potential for some opportunity cost based on staying with the stock that's already made a really nice move and is just kind of building a base. There is some time loss there where your money could be working somewhere else. However, on the flip side, a swing trader is never going to catch a 300, 400% move unless they have a rule where if they have a certain amount of profit cushion, then they switch over to more position type trading rules. But a position trader could have, a lot less trades and have extremely great success if they find the true market leaders and enter those stocks and participate during those longer moves. So there's pros and cons for both of these. And for position traders, this I think is better suited towards traders who are doing this part-time. They have a full-time job. There's less action they need to take, and it's a little bit calmer as well. You can look more at weekly charts. While swing traders, it's a little bit more maverick. You've got to kind of keep rotating your money to turn over your edge. So that's a little bit on the differences and pros and cons versus swing trading and position trading. And I think with that said, you can kind of adopt a hybrid approach, which is kind of what I've done to get a little bit of the benefits of both, depending on the market environment and the situation. And we'll talk about that in the rest of the webinar. All right. So these were the basic sell rules. Again, sell your first 50% of your position of 5%, and then depending on swing trading versus position trading, sell on 2 closes below the relevant moving average. There are some progressions as you gain more comfortable. You're more solidly in stage 2. You feel like you're stage 2 plus. So this is you. Listen up. This is the time to pay attention. The first progression, and I do want to emphasize here to not rush this process, especially if you're very early in stage 1. It's going to take time to really internalize these rules. And just this basic rule set can do extremely well during trending environments and when growth stocks are working. So don't feel like this is, putting on training wheels. This can do extremely well and will also protect you when the market isn't quite as strong. But these are some progressions that you can adopt if you feel like you want to make advancements, and these are potential tweaks to your existing process. If you've got your own existing sell rules, these are some ideas for you to maybe adopt to tweak and improve them over time if you find them helpful. So first, instead of selling half of your position at 5%, instead do a third and sell the next third at your average gain over the last 20 trades. And then sell the last third on the normal 2 closes below the moving averages. So instead of selling half at 5%, you sell a third, another third at your average gain, and then the last third on in weakness using the moving averages. The next progression is to sell a third at 5%. A third into strength as the stock gets extended above your average gain and gets, as I say here, gets visually extended from a moving average. And we'll talk about different ways to determine extension later on in today's webinar, and then sell the last third on weakness using the same moving averages. The next progression is to use the rule above, but allow yourself to add back a third if the stock forms another low risk entry tactic. So again, this is a little bit more advanced. It's about trading around a core position and, re-entering a stock if there's another lower setup against a moving average, a new base forms and then sets up again. You can add back a third that you sold prior. And then the last progression is to, again, sell a third at your average gain. So you're no longer using that 5%. You're looking to hold a little bit longer, a third into strength, and then a third into weakness using the moving averages. But you can also add back up to 2/3 of what you sold if the stock forms another low risk buy point. So let's go through an example, that same example of VST, applying these different rule variations. All right. So again, this is the same VST trade. You're using the same entry tactic and buy point here. And this is the first variation where instead of selling 50%, you're selling a third at 5%, a third at your average gain, and a third at 2 closes below the MA. So here is your initial sell of 5%. You've got remaining 66% instead of 50%. Your sell 2 is at your average gain, which we used in this case, an average of 10% gain. You sell 33%, and you've got remaining 33%. Then the stock trends, and you've got your normal sell rules below the moving averages for swing traders down here and position traders up here. And you might note that this actually performs worse than the first rule set that we talked about. But again, this might be a little bit more dynamic and might feel more comfortable for swing traders, especially to sell a little bit more. And then you can rotate that capital to another opportunity versus being stuck into a stock as it's trending above the 21 EMA and waiting for that last bit to sell before you can move on. So this is a rule progression that you can adopt. Maybe you prefer the first set. Go with that. Figure out what works best for you and use those sell rules. Here is the second variation where you're selling on the extension instead of at your average gain. So again, your first sell is up 5%, move your stop to break even. That protects you. Then you've got an extension here, a gap up and strong move. You didn't sell at the high of this day. You sold as it was pushing higher and really becoming extended with a gap here. And then you've got your last sell again under the moving averages. Swing traders again taken out here. Position traders get taken out here, and you have, again, pretty strong gains here, about 20% and about 27%. So performs better in this case than the prior variation. And again, it's not about individual trades and how these rule sets work on, an individual trade and individual stock. It's about how they work over time and how they fit your personality, how much risk you like to take, how much drawdown you like to experience. Because if you don't like experiencing drawdowns, you want to sell more into strength, more as the stock is going up and making momentum moves, and just letting a trailing piece on for a bigger move. So it's all about fitting these rule sets and figuring out what works best for how you view the markets and how you experience risk and your own personal risk tolerance. Here's variation 3, where you can add back 33%. And here's the add back point here as it formed a new base and undercut and reclaimed the 2021 EMA and broke out of this base here. For a swing trader, you actually sold out of your whole position before that, but you added back 33% because that's in your rule set. You're able to do that. And you ended up selling that for a 23% gain here as it broke down back below 21 EMA, a little bit higher. You've got a 23% gain instead of about a 20% gain. And for a position trader, you actually added back here, and your overall net is a 31% gain. So you sold 33% up 59%, and that last 33% that you added back, that you sold back here at 5%, and added back here as well. So you've got a little bit better of a gain. So again, this allows you to trade around the core a little bit more. And this next variation allows you to re-enter 2/3. So you've got your swing trader here up 29% now, and you're able to stick with that trend a little bit more. And position trader just gets a little bit more juice and a 35% gain because they were able to add back on the next low risk buy point a little bit more and trade around that core position. So those are the 4 variations. Again, here is basically the definitions of them. And in the chat right now, let me know which kind of rule set or variation kind of appeals most to you. And again, it's going to be dependent on your situation if you like to sell more to strength versus weakness, and also again where you are in your trading journey. If you're more advanced, you're likely not selling half at 5%. Maybe you're selling half at your average gain, half into as an extension, holding the rest for the 21 EMA. But let me know in the chat which variation kind of makes the most sense to you and how you like to personally trade. All right. Jay Patel says number 2, 1 to 2, and fast number 4. So we've got a mix. Again, everybody's going to think a little bit differently, and different rule sets are going to appeal better to different situations and different types of traders. But again, these are just examples as well of tweaks you can make. Maybe you're not going to adapt exactly variation 4, but you might tweak it to how you like to trade and your personal sell rules. Now for stage 3+ traders, the goal is different. Again, the goal for stage 1 and 2 is all about building consistency, establishing an initial system to actually test out who you are as a trader. Stage 3 and stage 4 is more about performance and actually performing really, really well. And sell rules will adapt to the character of the stock and the actual market environment. Maybe the market environment is rewarding strong trending markets, holding onto positions longer, you adapt a little bit more and lean more into selling into weakness versus selling into strength. And sell rules are tailored to the trader's biases, selling into strength or weakness, again, based on their personal way of interpreting the markets. And instead of rule 1, which is sell at 5%, you can sell at extensions as your first sell instead of fixed levels. So you get a little bit more variability in your sells, but it might lead to increased performance over time. And instead of sell rule 2, which is breaks below 2 moving averages, you could divide sells between the 21 EMA and the 50 SMA to hold a little bit longer. And you can use judgment on the negativity of the 2 close below a moving average. And what I mean by that is, let's go to this this example actually right here. So this first close below the 50 SMA is very negative, but the next close is higher than this bar right here. And let me zoom in here to actually really show this. So this first close below the 50 SMA is very negative, closing at lows, big range bar, but the next day is an inside bar that closes higher than this close. If you want to be, if you're more of a stage 3, stage 4 type trader, this might not trigger your sell rule as 2 closes below the 50 SMA, because this close is more positive than this close right here. And that allows you to stick with that trend and, stick with it. This low is never lost. That could be your rule. If it breaks below this low, that's your sell rule. And you hold on, and this one rallied and kept on going. So that might keep you in a little bit longer in certain situations when a stock is very strong. So that's kind of a nuance or variation that you can adopt if you would like to as a stage 3 or 4 trader. So those are some ideas for the more advanced traders out there about how to adapt their sell rules to be a little bit more malleable. And you can do that as a stage 3, stage 4 type trader. But again, stage 1 and 2 is about rigidity, system, consistency. Stage 3 and 4 is about performance, and there's a little bit more discretion and variability allowed for those type of traders. All right. So here's a stage 3 example, maybe how you would apply this as a stage 3 trader. These are similar to my personal sell rules. So you've got that same entry point. Your first sell isn't at 5%. It's at this first extension up 20%. You've got still, and you're not selling a third, you're selling only 25%, looking to hold the majority for a bigger move. You've got another sell on another extension. You sell 25% of 54%. You've got 50% remaining. And your last sell as a swing trader is 2 closes below the 21 EMA. You sell 50%, up 34%. So you get a nice trade overall. And your rules allow you to re-enter 100%. Or if you still have a full position, add 25% back. So here on this next lowest buy point, you re-enter. And your final sell as a swing trader is 2 closes below the 21 EMA. With that last trade netting another 12.7%. So instead of about a 20% gain, which we talked about with the previous variations for earlier stage traders, you have almost a 50% gain. And that's where the performance really comes from, is waiting for those key points, this extension, this key reversal bar extension, and being able to add back and start a new trade within that same longer term trend, a new swing trade when we get a reinvigorated momentum move. And even looking at this example, a stage 3, 4 trader might not be waiting for 2 closes below the 21 EMA in this case, because look at this bar. We break all these lows altogether, this lows as well. So you might have actually raised your stop to this element in structure and, improved the second trade here and gotten a little bit more juice and performance out of the second trade. Again, just adding to your overall profit. For a position trader mindset, again, maybe you sold one here into the extension, sold again here, and then you add back here and you're selling, the 25% position up 10% here, and overall get a 61% gain. So both of these situations, this shows how a stage 3 type rule set, which is a little bit more adaptive, a little bit more discretionary, a little bit up to the personality of the individual stock, can allow you to perform better. But this is only available for stage 3 and 4 traders who have proved themselves to be able to manage risk. They've built that technique over time and use that rigidity that they learned in stage 1 and 2 to allow them to be a little bit more creative in stage 3 and 4 to perform a little bit better. So this is an example of how to apply a little bit more of a fluid rule set that adapts to the personal situation. And this is pretty similar to my personal trading rule set as well. All right. So a little bit more on market environment and sell rules. Different market environments will favor quicker rules and put more emphasis on selling into strength or weakness. And this is a really important point because I think a lot of people get worked up about, there's a 2024 or 2020, and they look back over their trades and they're like, wow, if I just hold until the stock breaks the 50 SMA or 100 SMA, I'm going to make 300% every single time. I sold way too early. But the reality is that not every year is like a 2020 or 2024. And the rules that would have worked really well in 2020 or 2024 are actually overfitted to that market environment that was extremely good and not going to happen every single year. And so when they adopt those rules that, to hold on to a stock until it breaks the 50 no matter what, the next year is choppier, breakouts aren't falling through nearly as much. And instead of getting those 300%, 400% winners, they get stopped out a lot. They hold on too long to their losers, to their winners as they're pulling back, way back into the moving averages. And they just don't perform using that rule set, which was supposed to be the secret sauce and perform really well. But the reason being that it didn't is because the market environment is not always conducive towards longer term, more position trading sell rules. So you want to remember that as you're looking back on your trades and deciding what rule sets to use, is you want to avoid overfitting and think about a rule set that is robust, that will adapt to different market environments, both really great trending ones as well as choppier ones, and protect you in those situations. And just be aware that a rule set that worked really well in a strong trending market environment may perform horribly in a very choppy, up and down volatile market. So that's something really important to remember. And a way to help you identify if you're in a trending or choppy environment that can be an input to allow you to switch rule sets or just be more aware is you can track your average gain over the last end trades. This could be 20, this could be 50, this could be 30, this could be 10. And if your average gain is increasing or decreasing, that can help tell you, are we trending or are we more choppy? If it's increasing, it's more likely to be a trending market environment where longer term sell rules may do better. But if it's decreasing, you might want to tighten things up because it is a little bit choppier. And also, I just want to point out that, this is pretty obvious, but is worth mentioning as well. Stronger markets after significant corrections as bear markets will favor those longer term rules. So you might want to lean more into, the position trading type mindset after a significant bear market or correction, like after COVID, after the 2023 bottom. That's when the long trends really happened. That's where we saw PLTR, NVIDIA start their 1,000% moves that would have held up really well with longer term sell rules. So keep that in mind as you go through it. And also, I want to mention here, when a market trend goes sour, it often happens fast, and growth names will all kind of drop in tandem altogether. So you want to be aware of that and act fast and manage risk in real time. And also, you can track the leaders carefully, and if they are breaking down, be on guard for more weakness, and that can help you inform you about the market environment and how you should be managing your positions. So this is just an important slide to think about how the market environment will impact which sell rules are working well in that current market cycle.